My name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of LME 3-month nickel, zinc and tin. LME 3-month nickel. The most significant feature of this market in recent weeks has been the very significant lows of 2021 at 15,665, which led to lows of late November 23, plus this year, January, February, and with some mild finessing the lows of late July and early September in the 15,840 to 15,600 zone. This support created the lows of late July at 15,600, early September at 15,665. It is at this point that I feel obliged once again to mention the big descending scallop pattern I've been going on about 4 months now, and what it may mean within the near-term universe. So the key level has been and is the lows at 15,840. A significant move below these, and by that I mean you would know it when you see it. A significant break below these would give a potential downside for the descending scallop pattern in the 13,830 zone, which would not be too far away from potential below for the old bearish half hesitation seen over June and July that eventually never materialized. It still all comes down to what the market has done and even now might still do in the 15,840 zone. My first time around in late July, prices chose to bounce back upwards and during the start of August sustained the bounce. However, over mid-August prices had an issue with testing the June 2021 low at 17,095. And I suspect indirectly the now flatlining gold long moving average currently at 17,365. This suspicion eventually evolved into a mid-July to early September ascending wedge pattern. Early 6 weeks ago, prices broke down through the now ascending wedge pattern, easily reaching the primary target and close enough to the secondary target at the July low at 15,600 for me to choose not to designate it. However, we then saw prices build upwards again, enough for me to draw a bright red late July to mid-September bullish Andrews pitchfork. I said on this 4 weeks ago, and I quote, "This is a nascent one and I'm quite prepared to retire it if it doesn't fit, especially if the support down at 15,600 being so close gives way." End of quote. Now I continued, and I quote, "The one other thing I would like to mention is that we might just form a possible double bottom over the action from July to date. It's way early to really consider this, but keep it in the back of your mind in case the 15,600 July low holds prices up and we really start to see the beginnings of a pullback up." End of quote. Well, since then the bright red bullish pitchfork has held, even seeing a temporary breach 2 weeks ago and again last week of the upper time, currently at 18,215. That was repaired with all things actually, a horn top. I added 2 weeks ago and I quote, "The price rise triggered the opportunity for the July to date double bottom. Thus we have a primary target X in the 18,140 area and a secondary hard to reach target X1 in the 18,665 area. In the way, bar the bright red upper time and October 2019 high, is the July 22 high at 18,265. But the more interesting features around the target X1 where we have not only the June high at 18,610 but the interesting 50% Fibonacci line, the big mid-May to late July move at 18,680. Indeed, you could call this area a small congestion band of 18,610 to 18,680. End of quote. We have since then seen prices reach the primary target in the 18,140 area but fail at achieving the secondary target so far. We are nevertheless still within the bright red bullish Andrews pitchfork just above the bright red middle time, which is currently at 17,320. I said last week, and I quote, "We're above the gold and mauve gold long and mauve medium moving averages, and until these are taken out, I will maintain target X1 up in the 18,665 area." End of quote. Now I still stand by that statement, even though we're testing the gold moving average at the moment. LME 3-month zinc. This is a very busy and colourful chart, and for that I apologise, but all these patterns do relate to what is going on right now, so let me explain. 7 weeks ago, prices drove higher, prompted by a small late July to mid-August reverse head and shoulders pattern, up over the June 2021 low at 2810 Over the broken old dark blue upper time, currently at 28.41, of the May to August 2023 bullish shift pitchfork that subsequently acted as an August 23 to April 24 upper bull channel line. Then the short medium moving average, currently 28.46. The medium moving average, currently 28.77. A congestion band between 29.58 to 29.65, containing the April 2019 high at 29.59, and the big 50% Fibonacci of the big old 2008 to 2022 move at 29.65. Plus further up the green middle time, currently 30.31 of the February to August bullish shift pitchfork. Then just over the 3000 level, the July high at 30.22, followed by the purple neckline extension of the September-December 2022 reverse head and shoulders pattern, currently 31.39. And finally, to slow over this purple neckline and halt just shy of the June 2018 high last week at 32.20. As is obvious, all this countered quite strongly July's monthly key reversal down. As a consequence of this move up, laid out 5 weeks ago, some potentials topside for the original reverse head and shoulders pattern were reached, a primary target in the 3009 area and a secondary harder to reach target in the 3087 area. So, looking back in late August, there was enough overhead at the time to turn prices lower, especially I suspect the green middle time at the time, all the way down to just below the long moving average, currently at 27.52, and the congestion generated during late July and August. However, once there, the congestion held, somewhat surprisingly to me, and the move up saw all these targets finally reached 2 weeks ago. Now, I said 2 weeks ago about the top zone, I quote, "Prices have moved higher still to now test what I suppose is the holy grail of this market, the purple neckline of the September-December 2022 reverse head and shoulders pattern. This could become a seminal moment, so watch carefully as prices have also formed another pattern, an early August to date bullish halfway hesitation that achieved its topside target in the 30.60 area in the middle of last week," that's 2 weeks ago, plus another pattern that is still operational, end of quote. On this still operational pattern, I said 4 weeks ago, and I quote, "I've also drawn a new early August to early September bullish Andrews pitchfork, highlighted in bright red, in a renewed hope in showing the bullish angle of attack of this market," end of quote. Well, this bright red bullish pitchfork has been operational until today. Today we have seen prices penetrate and breach the bright red lower time, currently at 30.31. And unless this breach is repaired and quickly, and it is looking a bit potentially like it might do that, unless it's repaired quickly, then this could see the start of a potentially significant move back down. You see, all this goes back to what I said 2 weeks ago, and I quote, "The question now is whether the market will falter here, much as it did in late May, or will it really go for the higher price?" Last week I said, and I quote, "Today it seems we have the beginnings of the answer." Well, that's the end of the quote. This week we may have the start of a confirmation of that answer. Now watch carefully continue, especially on the downside. Keep a close eye on that red lower time and also on the 29.40 area, the zone below at 29.40. LME 3-month 10. Prices started their recent build higher down at the congestion between 28.835 to 29.005, containing the July 2011 high at 29.005, plus the important slowly rising long moving average, currently at 34.10, and what was back then the nearby neckline extension for the October 23 to January 2024 reverse head and shoulders bottom, which is currently at 28.295. And finally, the 50% Fibonacci line for the March 23 to April 2024 move, down at 27.330. All these slowed, stopped, and at the start of August turned prices higher. The push back up then became stuck in what I can best describe as an accidental congestion area overhead, created by a combination of the medium moving average, currently at 32.085, the short medium moving average, currently 31.905, the 50% Fibonacci on the March 20 to March 22 move at 31.845, plus the neckline of the thin and tall April base head and shoulders pattern. Yes, that one. The one I mentioned a lot back then, currently at 31.895. Prices were stuck there until 4 weeks ago when they broke higher, moving up over an earlier all-time high from April 2011 at 33,610 and up to the 50% Fibonacci line of the March to October 22 move up at 34,1775, where they breached but could not break any higher. I said of this 50% Fibonacci line last week, and I quote, "This latter one seems to me to be a significant level, but we'll see." To help clarify this move higher, I drew 3 weeks ago, so that's now 4 weeks ago. I drew 3 weeks ago a late July to early September bullish Andrews pitchfork, highlighted in dark blue on my daily chart. End of quote. I was the first to admit that this was not a perfect pitchfork, but the market still utilized it until last week when prices punched down through the dark blue lower tie. So I had taken the step today to finesse this acute dark blue bullish Andrews pitchfork to a shallower dark blue bullish shift pitchfork, which you can see on the screen at the moment on the chart. And so far this has worked well, with the market in between the overhead dark blue middle tie currently at 33,295 and below the dark blue lower tie currently at 31,345. Now, what is the market facing now? Well, as I said last week, and I quote, that below we have a dynamic congestion band between today 31,845 to 32,085, made up of the medium moving average currently at 32,085, the old thin head and shoulders top neckline extension I mentioned previously currently at 31,895, the 50% Fibonacci line of the March 20 to March 22 move at 31,845, and the short medium moving average currently 31,915. This seems an obvious support zone below. End of quote. I should like to highlight that this congestion zone today is narrower than it was last week, but such is the function of the moving averages that we may well see this congestion zone narrow and expand as the days go by. Today, this congestion zone has been penetrated and skewered right through, but the market right now has retreated back upwards. So for now, it is still a good support zone. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.